The Morgan Report with David Morgan.
David Morgan with you with the weekly perspective for the week ending the 13th of April 2018. Well, some general comments on the overall market. First of all, commodity prices are rising. Recently, we had a crude oil breakout that, of course, giving a boost to all the energy shares. And small caps continue to show relative strength. The S&P 500 is near resistance and looks like it's broken through. And there is some wavering in the bond market. I want to move over to the one article here that I'm going to talk about to start with. This is kind of all-encompassing. I often refer to Charles Hugh Smith, and I'm happy to do so again. The title of the article is "The Genie's Out of the Bottle, 8 Defining Trends Are Reversing." I'm not going to go through the whole thing. Very much encourage everyone to read the entire article. But the 8 major trends are central banks' distortion or manipulation of the markets, the business cycle, interest rates, commodity cycle, stock market cycle, regulation, globalization, and demographics. I'm only going to key in on a few of these because I think you should read the article, and I'm trying to make this succinct. But he talks about the manipulation of the markets, the distortion in the financial system due to the QE and a lot of other things. Regulation's a separate topic. But the one I want to key in on first is this one here with the Goldman Sachs Commodity Index divided by the S&P 500 ratio. Equities expensive, commodities cheap. Very interesting chart. I think everyone should really study this, at least take a hard look at it. And what we're seeing here is, of course, the inverse, and that is commodities and equities. And what we see at the peak of this chart is that you had a peak in the commodity cycle in the 73, 74 oil crisis. I was around then. I was already driving. Gulf crisis, 1990. And, of course, what happened in 2008. Also, the green circles at the bottom of the cycle, you can see over here on the far right, it's cut off a little bit, as we're basically in that same zone right now, which anyone that plays cycles or wants to be on the right side of the trade or continue to make money through the ups and downs of the financial system needs to know when to sell high and when to buy low. And the best thing you could do right now, at least looking at this chart from my perspective, is to be liquidating equities and moving into the commodity sector. Another one of these is the demographics. This one's rather short with some links. I just want to read part of this because it's so important. This is one that Harry Dent has done a great deal of work and written a couple books, if not more than 2. And here Charles succinctly says, although they may put their hopes on robots generating unlimited wealth that will support the elderly and free the working age population from labor, the more likely prospect is an economy that cannot fulfill the promises made to retirees back when the worker-retiree ratio was 10-1, not the present day 2-1. This is a big problem. These are promises made by governments that cannot be sustained, cannot be maintained. I think most anyone that listens to my channel knows that there's many, many problems in the system. And one, of course, is the payouts that are purportedly there for retirees throughout city government, county government, state government. It's just not available. So there is a big day of reckoning ahead of us. Most people have been taught to rely on others, not to rely on themselves. And this is going to have repercussions throughout the entire system. Just wait. Next up is from Zero Hedge. I usually have that on every week, at least one article. The IMF's Christine Lagarde, global trading system is in, quote, danger of being torn apart, end quote. Without mentioning either the U.S. or China by name, the IMF head and convicted criminal Christine Lagarde warned about the dangers of the world being sucked into a protectionist spiral. Lagarde said that the global economy is benefiting from surging investment, recovering trade, and favorable financial conditions, which means low interest rates, all of which are encouraging companies and households to spend more money. My comment, Boulder Dash, The only thing that's really gone on in any substantial way is that the equity markets globally have surged, making the rich richer. But as far as on-the-ground economic conditions, if what you said were true, then you would see food prices getting lower and you'd have better food products, more choices. Households would have more disposable income. Housing costs would come down. Utility costs would come down. If you had a surging economy that was benefiting the people at large globally, anywhere, or at least in certain sectors, big sectors, you would see something to that positive effect, not just a bigger number on a DJI, S&P 500, Hang Seng, or whatever you want to name, whatever global equity market you want to talk about. Lagarde said the rise in global trade reduced extreme poverty, reduced the cost of living, and created millions of high-paying jobs. I, again, comment, Boulder Dash. Really? Global, this trade, these extremely low interest rates, this huge surge in global equities has reduced extreme poverty? Perhaps a few cases, but certainly not in anything of substance. Reduced the cost of living? Well, she's not paying my food bill, insurance bill. And created millions of high-paying jobs? No, I think the opposite's true. A lot of high-paying jobs are now working mediocre jobs, or working for less pay and therefore working two jobs. So, again, Boulder Dash. But I will have to be intellectually honest here. She talks about the restrictions that happens when you start these quote-unquote trade wars. And we wrote about that in the last issue of the Morgan Report. I won't say too much other than they really don't work. They never have worked. And this could cause further problems in the system, and I would have to probably agree with that statement. There's lots of big news for the week, but I cannot do a perspective without having to comment a little bit. This is from Bloomberg. Zuckerberg says Facebook collects internet data on non-users. I think enough said there. I mean, a lot has gone on. My friend Greg Hunter calls it two-faced book. Very interesting, the hearings. I think Zuckerberg did an extremely great job of shuffling, sidestepping, dancing, and everything else that a good political type would be able to do when avoiding direct answers to direct questions. Remains to be determined what will happen from this fallout, but obviously they are a politically slanted enterprise, but they kept bringing up the terrorist card as the reason that they put out certain signals to certain groups and take them off of the platform Facebook. It is a private company, so actually they have that right. I want to make that clear from, not only my perspective, but from the legal standpoint. Nonetheless, a very interesting back and forth, and I'll leave further comment for a later date. So I want to finish off like I do every week with some comments on the precious metals. Very interesting week. This is a 1-month chart of gold on my account. And I do this for paid members, not on a weekly basis, but usually a couple times a month. Regardless of that, what we had was this big scare of war, blah, blah, blah. And we saw gold move late in the week from roughly the 1342 area all the way up past 1367 momentarily, and then basically right back down. So obviously gold is still locked in this trading range between roughly 1355 and let's say 1335, or maybe a little lower, 1330 you could say. And it was very interesting to see this turnaround. I mean, there was a lot written about it. I don't want to comment further other than this. There's been some criticism out there, and I certainly have gotten my fair share of it. And a couple of analysts that I do respect, and I know them both well, will remain unnamed, but both of them went on to talk about that gold is not so negatively correlated with the stock market, which I've been saying over and over and over again. And certainly you can make that case that at certain times they move together and that it's not always a direct inverse. And that's true of anything. I mean, there's nothing that's 100% negatively correlated with something else. However, someone that I respect these other analysts, but the one that I probably put above both of them that I really, really respect a great deal is Fred Hickey. I don't mention him often, but the high-tech strategist, I I think one of the best out there. And what he says is what I agree with, and that is that while there are times that gold and the market, the stock market, move together, the negative correlation is high over the long term. It's just like the book, The Golden Constant. If you read Professor Roy S. Jastrom's book, The Golden Constant, gold maintains its value over the long term. Doesn't mean that at times it isn't undervalued, fair valued, or overvalued. It is. But over the long term, its basic purpose is to maintain purchasing power, and it's been proven again and again and again. But if you want to put up the starting line at a certain point and measure it for a certain distance, you can build almost any case that you wish to do. So enough said on that. I'll stand by what I said over the long term, and with Fred Hickey basically agreeing with me, I think I'm in good company. And finally, some remarks on the silver market. The World Silver Survey from the Silver Institute, Thomson Reuters, is out, and you can download it for free off of their website. So I'm going to just look at the opening summary and outlook paragraph. Last year, for the fifth year in a row, the silver market recorded another deficit, this time 26 million ounces. Mine supply fell for the second consecutive year by 4%. In 2017, following 13 consecutive annual increases prior to 2016. This was a result of years of capex reductions in combination with supply disruptions, particularly in the Americas, with scrap supply contracting by 1%, in combination with net hedging of 1.4 million ounces, 44 tons, metric tons. Total silver supply fell by 2% to just under 1 billion ounces. One further comment on this, and this, of course, agitates a lot of silver investors. So you have the word another deficit, and I want to explain again that the above-ground silver supplies have been building for the last decade or so. The reason that it's called a deficit by the World Silver Survey or the Silver Institute is because of investment demand. I'm not negating that. In fact, I agree with it if that's the metric you want to use. What I do also want to state, for the record, is that the above-ground supply has grown. I also would like to state for the record that industrial demand has remained flat, maybe increased a bit. You can read the report. However, the retail demand last year was actually quite poor relative to the strength that is shown in prior years. I think it's something that you can blame the Bitcoin cryptocurrency world. I think some amount of silver investors were just pretty much gave up, cashed out, and went into the crypto world, and good for them. I think a lot of people that did that are probably happy with themselves. And I don't want to belabor this, but it's a good report. I agree with most of it, but I just want everyone to be aware of what this deficit word means in this outlook, because if you read the CPM Silver Yearbook, you'll see something different. And they're both right, and how can that be? And it's, of course, the definition of the word deficit. And so I'll leave it at that. Next week, I probably will not do a perspective. We'll be coming back from a business trip, and I'll be in the air, so I'll either do a quick one on Monday the 23rd or just forego it and do the next one on the 27th. Until then, I wish everybody the very best.